Well, you will have to admit that an expected dovishness is not there. As expected, a pause. As expected, not a comma changed in the stance, aligning inflation to the target while supporting growth. So withdrawal of accommodation remains. Nothing changed. But I would say where an expected dovishness was disappointed was that the inflation target was expected to come perhaps to 5. That was the conservative estimate. There were a few hopes that it would go even below 5, but at 5.1, it's neither here nor there. So the governor has not exuded that level of dovishness over the inflation target. Maybe they have it in their mind, but they don't want to express it, probably because of El Nino. And the repeated insistence that they will not be satisfied by simply coming within the broad range of 4% CPI plus or minus 2%, that is, coming below 6 is not enough. The target of 4% will be important. In various ways, he emphasized that several times. So I would say, if you were looking for dovishness, you were disappointed. It was almost a cut-paste of last time's policy. There has been a minor shuffling in the GDP growth forecast, with the first quarter GDP bumped up and the latter quarters 3 and 4 brought down. Likewise, in inflation, the first 2 quarters brought down and the latter quarters remaining unchanged. So overall, just a 10 basis point cut in the inflation forecast for the current year. It's very, very much a status quoist and cautious policy. Governor not willing, or rather the MPC and the RBI not willing to relinquish any vigil. The bond market yields were already higher before we went into the policy. They were standing at 7.002% just as the governor started, and they are now at 6.99 thereabouts. So it's actually moved down a bit, but that was only because the market had already gone in cautious ahead of the policy, and therefore there was just a minor give back. You might say the bond market reaction actually is marginally negative compared to where it closed yesterday. Well, those are the preliminary observations. Ritu, anything you want to add, or we can straight away go to Kaushik and Abheek for their observations. Ritu.
That's right, Lata. I mean, you know, the primary focus, I thought, something we weren't really expecting, because is the insistence that 4% is not enough, you know, that 2 to 6% is not enough, and then we have to get to 4% inflation. I think that was one of the biggest takeaways. But on that note, let me invite in our experts to decode the policy for us. Kaushik Das still with us, Chief Economist, Deutsche Bank. Abheek Barua from HDFC Bank. Amandeep Chopra, Group Head of Fixed Income at UTI Mutual Fund. And Ashwini Kumar Tewari, MD of Risk and Compliance and Managing Director at State Bank of India with us. Gentlemen, thank you very much for your thoughts. Quickly, Mr. Barua, let me come to you. What were your key takeaways from the governor's statement?
Well, I thought it was an objective assessment of things, with a tinge of dovishness, in the sense that the way he characterized the economic situation was the proverbial sort of Goldilocks scenario. Everything seems under control. Yes, of course, there are risks, but he's not being alarmist about it. I think only those who had expected a change in stance, which I think the majority was not expecting, would have found it a little disappointing. But otherwise, I think both the revision, the fairly dramatic revision in the first quarter inflation forecast, the second quarter is revised down a tad. Maybe they are being cautious about the second half, but that could also come down. So I think the fact that he emphasized that India was in a good place, whereas various other countries, especially in the developed world, had their fairly acute problems persisting, was kind of hinted at a level of comfort, which I think the markets should draw some comfort from. Well, the 4% target is certainly there. That has been emphasized in the past. The Arjuna bit, the constant vigilance has been emphasized in the past. I don't see this as a sort of new developments or a sign that they are getting they are now focusing on the long term, and hence that will change the rate or the liquidity management trajectory in any significant way.
Got it. Yeah, Got it, Abheek. Let me just get quick comments from the others and we'll come back to you. Mr. Ashwini Tewari of State Bank of India with us, so the biggest bank. What have you all made of it, Mr. Tewari? First of all, thanks for joining. It is status quo, but I think the big relief for banks, and now we have to call it a relief, is that there is no sign that they are going to cut anytime soon. I don't know what the swap market is saying right now, but your reaction, do you think there is space for loan rates to go up, lending rates?
So I don't think the loan rates are going to go up in any significant manner. Some of the banks are still not fully caught up with the RBI cycle because the reset in MCLR and the various scenarios is at a 6 monthly, 1 year kind of trajectory in some cases. So that catching up will happen. But in terms of general pickup of loan rates, especially in the EBLR kind of rates, I don't think there will be any increases by the banks because the Reserve Bank is clearly indicating that the status quo or peak cycle has been reached. So the banks will stay the course. And of course, the natural increases will happen linked to the MCLR.
Okay. Well, just a word on the stock markets as well. I think they remain at about a 0.25% higher, 40-45 points higher for the Nifty. So the Reserve Bank has not given the necessary bump up for the market to reach out to the skies. But maybe the market may ruminate over it. There's still nothing negative at all for financial markets, but perhaps a sharper cut in the inflation forecast or even a smidge of an increase in the GDP forecast may have been a bigger tonic for the equity markets. That's not come. It's so status quo as it gets. Kaushik, your thoughts? Do you think that an expected dovishness is lacking? Just your takeaways.
Lata, I think, it's along expected lines. Whatever we expected happened. I told you earlier that even if they could mathematically reduce inflation to 5%, probably they would be cautious and just do maybe 10 basis points just to keep some buffer. That's exactly what has happened. But, I will contradict a bit with, Abheek, and I think it's actually hawkish on the margin if you read through the, different statements. One, which you pointed out, the governor is now repeatedly saying that don't get complacent about the fact that we have come to 5% and that RBI is more or less happy with 5%. Our target is 4% and we need to go to 4%. That's why he mentioned that we are not going to go below 4% or close to 4% in FY24 at all as far as inflation is concerned. So he is indicating to market that our target is 4% and we have to reach there. And for that, whatever we need to do and, hold on for a longer time, we'll do that. So that's a bit hawkish on the margin, and they're repeating that continuously from now on. The second part is, I think you observed that you mentioned somewhere that core inflation has to come down durably in order to get to that 4%, headline, CPI target, which means that RBI is, also focusing quite hawkishly on core inflation, because unless core inflation converges towards 4%, RBI probably would not be very happy or inclined to cut interest rates. So the takeaway from all this and looking at the inflation forecast, if you see October, December is at 5.4, January, March next year is retained at 5.2. RBI is not going to cut anytime soon. And we know that the Fed is probably going to hike in July, and probably the Fed will only cut in March of next year. So whoever was expecting, or if markets were expecting that October, December RBI could move by cutting rates, we don't see any kind of reason why RBI should. And if you look at the growth forecast, actually 8% for April, June, when markets are at 7%, and 6.5 for July, September, it's quite on the bullish side. And consensus is for a 6% growth this year. RBI is for 6.5. But if RBI's forecasts are met, then the logic for rate cuts get pushed back, and probably in April of next year is when you could expect RBI to start cutting rates, and we have a prolonged extended pause for now.
Okay. Well, actually, sometime before, I don't know about yesterday night, but a few days back, the swap markets were pricing a cut even as early as December. Right now, I'm told by some dealers that they are pricing in February. So clearly, this market has seen it as slightly more hawkish than they expected, at least a week back. The cut expectation is pushed to February. My sense is that people are playing an electoral guess over there. April or February, but maybe they are going with February because of an electoral pre-election expectation. In any case, by then we'll have a very clear idea of food inflation as well. Kharif and Rabi will be in. What is the bond market taking away by way of liquidity? The governor did say that 2,000 rupee notes are coming in. He has given the clear impression that liquidity is still ample, and that is why the withdrawal of liquidity stands. Amandeep, your thoughts in terms of liquidity and bond market takeaways?
Thank you, Lata. I think on liquidity, clearly the governor has articulated their desire to keep liquidity within a much narrower band, since they need to maintain their withdrawal of accommodation stance. So, beginning of this month, thanks to the 2,000 rupee recall, we had seen SDF numbers shoot up to almost 3 trillion plus. That's come down now because of the variable rate reverse repos to just under 80,000 crores. So I think that's more or less in line with the kind of levels we were seeing prior to the 2,000 rupee recall. So my sense is that they will like to keep operative rate at the repo rather than it come down to the SDF rate, and that will ensure that the liquidity in the system will remain somewhat very close to the neutral zone. And that's effectively implying that, the SDF numbers and maybe the durable liquidity in the system does not exceed about 1 trillion odd rupees. On the rate front, while you're right, most of the announcements in the policy were as per market expectations, no surprises there. But I think, there is a slight tilt of hawkishness in some of the additional comments which the governor made. Two of which, in my view, clearly articulate the fact that, there is a lot of uncertainty in terms of the inflation trajectory going forward. And while we may have some comfort drawn from the 5%, inflation forecast, but the number of risks which he highlighted and the allusion that he had to, what has happened in Canada, Australia, beginning of his speech, combined with, what's also happened in New Zealand earlier, does indicate that the future path of monetary policy is somewhat uncertain. So effectively, that's kind of also driving the current pause and maybe, a furthermore pause in some of the subsequent policies, because they want to keep their options open. And having seen the experience of other economies, maybe they want to, make sure that whenever they do pivot or whenever they do change, they do have sufficient grounds and enough data to prove it. Between the last policy and the current, policy, if you really look at the data trends, there is nothing material which should actually influence their decision on either side. Finally, the other comment which I think, I would agree, was also referred to by another panel member, was largely around the fact that, he's been reiterating that the 4% inflation number is more material from their objective. And if you recall, in the post-policy speech in April, he alluded to the pre-pandemic average inflation rate of 3%, which is when they were cutting rates. So my sense is that, while we may be comfortable with a 5 or sub 5% average inflation, but the 4% and the reiteration of the 4% target does indicate that this pause may be a bit longer than what was anticipated. And it's reflected in the swap yields, right? I mean, you've seen actually the 1-year move up, the 5-year also more or less go back to the April policy levels, indicating that the rate cut expectations are further moving out. Earlier, they were as early as October, moved off to December, and now they're indicating February, which I think is maybe more pragmatic.
Okay. All right. Actually, even February is an 80% chance. That's how I should put it, is what the dealer is saying. It's not as the stock markets are saying 25 bips in February, but an 80% chance only. So for all you know, Kaushik's point of April, 25 bips could be. But the important point is this is not what the swaps were pricing in. The swaps are pricing in something better. And as Amandeep said, on the margin for the bond markets, this is a little more hawkish than they were expecting, especially the inflation number, which has come in at 5.1 compared to 5.2, considering there is a good 60 basis point cut in their Q1 expectation. Q1 they were standing at 5.1, now they are 4.6. Half a percentage point cut in inflation in the first quarter. It still means that for the full year they are not willing to go down much. I guess these are El Nino fears, and the fact that rice prices have already risen. MSP is higher than expected. So playing caution over there, and therefore rate cut expectations have clearly been pushed out. That may also explain some bit of caution in the stock markets. Mr. Ashwini Kumar, there are a lot of developmental announcements. None of them seem to be terribly material, except that in the call and notice market, Now how much you lend is a limit you can put in. RBI will not put in any limit. For a person like you, it must be a very big freedom. You all are usually lenders in the call market. Is that big?
Yeah, so it is a much more, it has eased the way in which we handle these things, because whenever some limits were set by RBI, then there is always that pressure to actually reach out to them and maybe request for a higher limit. So in that sense, the shift to the principle-based regulation, as the governor has been saying for some time, from a prescriptive regulation this is one of those steps. I would rather urge more than this. We are a lender, you are right, but more than this, I think the more significant announcement is the digital first loss guarantee guidelines, which are going to come in and will clear up the space around this lending, which had increased, then fallen off because of the lack of clarity, and now hopefully should pick up again. And that the linkage to the financial inclusion from that part, because these are typically small ticket loans, I think that is a much more significant announcement. Others are simplification, and we will watch out for the guidelines on compromise, OTS, restructuring, etc., which he has said that will be issued in some time. So we'll wait for the detailed guidelines to come. Many of these the significance of these will then be known much better than it is now.
Now, I take your point, sir. I thought that first loss default guarantee rules are going to be made, I mean, they're going to guide that market. That's very important. Because it's an unlisted market, I didn't pay too much attention to that. I don't think there are too many listed players in that space. But maybe my startup colleagues in the startup team will be looking at valuations for the, fintechs on account of this. Ritu herself is quite a master at that. And maybe by end of day, we will have some clarity. But these are guidelines that are going to be announced. That's always welcome. When Reserve Bank issues guidelines for a market, that market gets a legitimacy. And so that may be actually positive for fintechs. But again, that's an unlisted market, not a public market. The bigger point that Mr. Tewari is making is that some guidelines are expected in terms of compromise settlements in bad loans. This is also very good because it will guide banks on how to do write-offs. There is a charge sometimes that, NPAs are hardly resolved. You're only writing it off by adding to your capital or your retained profit. Perhaps some rules in that will also help bring some legitimacy and cleanness to that system. But both these are hygiene matters. I don't think they move the needle in terms of, credit cost or EPS. Am I right, Mr. Tewari? Nothing to impact earnings.
You are right. See, these are things because in our regulation, which the RBI does in the supervision exams which happen, many times some confusions keep coming where there is lack of clarity and therefore difference with the teams. And therefore, we have been taking up with RBI on many things in these areas. And RBI has been saying that we will clarify them properly at a quick time. And maybe some of these things will be addressed now when we go along. You're right, it will not cause a much larger shift in terms of credit costs and all, but each account resolved in a proper manner helps. So in that sense, this hygiene or whatever way it extends, I think it will be very useful to the banking system, especially for banks like us, which have large portfolios, even though the percentages are small.
I take your point, sir. So that extending of these hygiene conditions and rules make it easier to reach compromise settlements. To that extent, should be easier. Gentlemen, we are winding up this discussion. But of course, we will be back at 12 when the governor addresses media and takes media questions. But before that, may I have a last, what you call rapid fire question? When do you all expect the first cut? Let me start with you, Abheek. When is the first cut, you think?
I think in February next year.
February. No, only one word. Let's make it rapid fire. Kaushik.
We are sticking with April. But I wanted to give you a little bit of reason you like it if you hear it out. Why April?
No. First cut. Sorry. Rapid fire, Kaushik. One word.
April.
All right. Amandeep?
I think I'll go with the current swap markets, February.
Mr. Tewari?
I don't want to speculate on governors' rate cuts and all, so I would pass this question. Thank you.
Okay. All right. Maybe I will not toss the other questions to you because they're more economist questions. What's your inflation target now, Abheek?
Average inflation, 4.8% for the year.
4.8, also much lower than the governor. And Kaushik?
5.2. We have maintained it at 5.2, keeping the buffer.
Okay. Okay. And any tweaking to your GDP forecast, I mean, after the recent events? Kaushik?
So Lata, we are at 6%. We haven't changed it after the GDP data for January, March. So we are holding it at 6%.
Got it. Okay, Abheek, yours?
6 to 6.2%.
All right. Got it. Gentlemen, thank you very much indeed for your quick parsing of the Reserve Bank monetary policy. The verdict from the market itself is that the complete status quoist tone maintained by the governor has been taken as slightly hawkish. The repeated insistence that they won't be satisfied with coming in within 6% or 2 to 6% band, but wanting to go to 4%, plus the fact that the governor did not even mention that pause is not pivot, clearly indicates that they are as far away from pivot as one can think of, at least further than people envisaged previously. The fact the inflation forecast also is not as dovish. It has been cut by only 10 basis points. That also will be taken as marginally less dovish or more hawkish on the margin. The verdict of the market itself is closer to 7%, that is the 10-year yield, compared to 6.98 yesterday. The complex of reactions is maximum in the swap market, where until a few days back, the cut was priced in December. Now only an 80% chance of a cut in February, again indicating that the market has taken it as slightly hawkish, oh so slightly hawkish, but otherwise a largely status quoist and an unexpected lines policy from the Reserve Bank governor. Let's see if he adds more color when he speaks to the press at 12 o'clock. That's when we will meet you. Thank you for watching this special coverage of the monetary policy. A break and then other news continues.